out what draws a much bigger crowd is actually having content. So the 7 A's all have content, and so now we're going to be having content. We're now starting once a month. We're going to have content 3. We're still going to meet every week, and once a month we'll have content, and we'll do that up to twice a month in a few months. So we're excited, tonight. I'm, very interested in one of the topics that Crypto Oracle is super interested in, because we're really focused on spending our time where we think we can have an impact on those areas of crypto that we think are incredibly important to focus on, that we need to get better at as an industry if we're really going to be a thing. And one of those things is token economics. So we started, Crypto Mondays is one of 6 meetups that we run. One of the others is is token economics. Is there anybody here from the token economics meetup? 1, 2, yeah. Okay, yeah. But so we started a token economics meetup a little more than a year ago. Kind of the first guy that I met who just blew my mind on token economics was this guy, Tom Bollock, who had worked at Zynga. And he had created a token economy with 60 million people in it. And that was crazy. And we haven't begun to approach that yet, but so we started the token economics meetup last March just so I could have an hour-long dialogue with Tom and download everything that he learned. And we've had a few others. This, I think, is the 4th meeting of the token economics meetup, which we're partnered with the Crypto Mondays meetup. And we're excited to have our guests here tonight from Ezra Capital, who are a couple of token economics experts. And you want to give us a little bit about your backgrounds and why you're into token economics like we are. Zach, you want to start?
Yeah, sure. Thanks for having me.
This is Zach Resnick.
Yeah, thanks.
Zach lives in San Francisco, so he's out here visiting. And part of the genesis was he was coming to New York. And Jack lives in New York, his partner. So Zach, how did you come to token economics? Give a little background on yourself.
Yeah, so we have a lot of a shared background. So we both met at Oberlin College Conservatory. We both played poker professionally and started a poker business together. And as some of you might know, there's a lot of synergy between the poker community and the crypto communities, especially the crypto investing and token economics communities. So when I was first getting into the space, mainly just investing my own money because of what I heard from other poker players, I wasn't really thinking about fundamental valuations or how to...
Was there any poker player you said, yeah, this was the Genesis poker player you told me about?
It wasn't so much a poker player, but a poker site. And playing on a poker site and seeing, okay, I could withdraw in this thing called BTC and get 5% more and get it instantly. So for that reason, a lot of poker players are both early adopters as real users as well as investors to the crypto space.
What year was it that you saw this?
Well, I first saw it probably about 5 years ago, but I didn't really act on it until about 3. And then...
What caused you to act on it where you hadn't before?
Having more money that I could just
So a common thing.
Yeah, before I didn't feel like I made sense to make this speculative investment in something that went down and up a lot, where I would just want to put that cash towards investing in myself playing poker, investing in others playing poker. And then later I saw it again and was like, okay, I seemed like a better investment, and I was able to make a more risky investment. So then when I started getting more serious and thinking, okay, I really wanted to kind of devote my full time and focus towards learning what I can about the space and perhaps adding value to projects and investing, the area that I found was there was kind of the least serious amount of thought and energy going into was how to value distributed networks, and saw that there was a lot of similar type of modeling and language used for traditional equities, where it didn't necessarily apply for these new types of assets. And that inspired me to move to the Bay Area and start the New Economy Fund.
And what year was this?
Moved there early 2018, and we officially opened August 1st, 2018. And kind of in the run up to that, did
Crypto winter, I think they call that.
Yeah. The beginning of crypto winter, great time to move out and start a fund.
No, I think you were right in the thick of it. Right, I mean, if you think of it, you know, it peaked in like January.
Yeah, it did feel like crypto winter in January, for sure. But yeah, and then after kind of doing consulting projects and looking at how other funds and other companies are thinking about economics, that gave me kind of more fire to, you know, start putting out some pieces and thoughts on, you know, how we think it makes sense to value these things and, you know, what we can add to the ecosystem. And now we're here just kind of continue to do that, support entrepreneurs, make good investments, and kind of help them, help projects when we can have models that really allow them to, you know, grow and flourish.
So I was a victim of censorship as an online poker player. They wouldn't let me get my money, which was frustrating. And along came
What year is this?
The money got cut off in 2012.
So
And I
you were
didn't-
like some site you were playing,
Yeah. And
one day you couldn't get your money anymore?
one day a lot of people couldn't get their money anymore.
Same me.
Yeah.
Yeah.
At least in the States. And it wasn't so much money that it mattered to me. But eventually I got my hands on my first Bitcoin as a result of, or that was how I got my money off that site.
So you, what year did you get your first Bitcoin?
2017. So
And by show of hands here, who got Bitcoin before 2017?
anyway, that's sort of an aside from my real journey in crypto, which I think is a lot of people, and I say this sort of, you know, in a self-deprecating manner. I thought crypto would be a good way to make money. I could invest in crypto and I would profit. And so at the beginning,
But you say that like you're apologetic for it. Why should you
I'm
be
not
apologetic for being a capitalist?
no, it's not an apology. It was naive at that time to think that I had any kind of edge in the space. And so the tokenomics front is, I guess it's where I think that I initially got an edge in the space. And
Well, so let's go back. So, and I totally appreciate when you say edge, and I totally think that, you know, the reason, obviously, that, you know, in my whole life, I was in business school in 1987. 1987, and I saw somebody from Wells Fargo come and gave this whole talk on indexing. And it would like totally blew my mind. I didn't know it existed. And he was saying why it's so much better than humans doing it. And so I totally get that, right? Most humans do not have an edge, so you're better indexing.
yeah, well, I think what was a really exciting process for a lot of people in the space, especially like the ICO boom, was, you know, you heard about a project, you read a white paper, you saw that there was some problem. It's like, oh, this is a terrible problem, and we have a blockchain solution for it now. Great, where do I send my money? And that's obviously maybe oversimplified. I think a lot of people had a more sophisticated approach. But overall, I think that what we found early on was that blockchain was so new and there was so little at scale, and there still is. Unfortunately, there's really no projects that are at scale. There's no,
Bitcoin?
No,
Bitcoin?
No, definitely not. Of course not.
Bitcoin is not at scale.
No.
No. No, people don't
Well,
use
so
it.
okay, so then how are you defining scale?
Millions of active users. You know, using it
Doesn't
for the
Bitcoin
use
have millions
case.
of active users?
Speculators, yes. But I think people using Bitcoin, well, okay, so that's a whole contentious area because
And there's, no,
one is-
I'm not looking, I'm not like,
No,
right,
no, and I'm
'cause,
not
right,
saying-
part of the problem, right, of any new thing, and this is a new thing, is just nomenclature, right? The words that we use
Yeah.
and the framework in which we think about it. And it doesn't have to be shared, right? I mean, this is, in my belief, this is infinite, like the crypto's ability to change every industry. Looks like the internet changed everything. Every industry, this will change every industry, is what I believe. And I think that when people see the crypto light and see what it can be, everybody sees something differently based on their life experience. And, you know, so I saw community, because I spent a lot of my career in community.
Yeah, so Bitcoin is an interesting topic in this area in terms of community, because we want to talk about is Bitcoin at scale currently or not. Something that I might say is that Bitcoin was initially designed as a peer-to-peer payment network, and has that.
Well, and Facebook was designed as something different from what it is, too, right?
Sure, and the reason I bring that up as an example is because that has become a contentious statement, which I think that probably a lot of you would agree with, that that's a contentious statement. It's the subheading of the white paper, but there's a lot of division for a lot of reasons, and I think that one of the primary reasons is that there is not consensus about what it means for Bitcoin to be at scale. Does Bitcoin at scale mean everyone is hodling and the price is $1 million? Or does it mean that people are actually using it in day-to-day commerce? Does it mean people are sending $5 to each other? Does it mean that people have a way of sending $5 million to each other in a frictionless way?
So do you still, so me personally, and you know, my bullishness at this point in Bitcoin is my belief that it's the world's best store of value. Gold is a $7.5 trillion thing. Bitcoin today is $50 billion, $140 billion, right? You know, so it's got 50x to go. If it just equals gold and it's better than gold, it should be, more. But that's not, and that's assuming that the money aspect, the currency aspect, is a zero.
So there's definitely, well, I'll say one more thing about this. This is interesting because it connects to the tokenomics front. And I think that one of the central questions of tokenomics, practically speaking, is how do you build a token that becomes valuable? People are interested in lots of different areas of tokenomics, but what unites most people and what gets the dollars flowing in terms of tokenomics consulting is how can I design my asset such that it accrues value as more users come to my network and start using this token.
And that's what, so I'm sorry, so we spent a lot of time, sorry, that's what that's what this evening isn't about. And by the way, is there anybody here in the audience who would call themselves a token economist, like anybody says? Anybody else? Okay, great. What do you do?
Currently, I'm working in Acropolis. It's like a DeFi startup. Maybe you know something about it. Yeah, I designed tokenomics for Acropolis, the whole thing, and for a couple of projects before. Also, I wrote for Cointelegraph as expert, and I've been involved in crypto from 2013, but actively involved in tokenomics from 2016 because before Ethereum there was no tokenomics.
Yeah. How did you end up here?
What?
Tonight? How did you end up here tonight?
Sorry, I don't understand.
Why is it that, do you live in New York?
No, I'm living mostly in Berlin. Token engineering.
Berlin is awesome. I think Berlin is I think Berlin is the capital of crypto.
European capital,
yeah.
A lot of cool
It's
projects.
crazy, yeah.
Token engineering meetups are there.
It's awesome. What's going on there, I think, is it's the San Francisco of Europe, right? It's this incredibly liberal, and it's even better in that it's incredibly cheap to live there.
I cannot say
Well,
it's
relatively
incredibly
cheap.
but
Relatively,
I know
it's cheaper than London and the
of
other,
course,
yes,
yeah.
and the other major metropolitan areas.
Yeah, in comparison with New York, it is super cheap town. It is cool, very safe, reliable. It is interesting. There you can buy a burger for $5. This burger will be cool than better than here, maybe. And I have a question to you. How do you think, what projects maybe from last 2 years have a best tokenomics?
Yeah, I've been thinking about this all day and I don't know.
Yeah, so first off, there's the means that we're evaluating token economics now is much more theoretical than it is practical, because as Jack was saying before, there's basically no projects that I can't really think of projects at a meaningful scale. So we have a lot of theses around like what works and why, but when we're like working with our portfolio companies or our clients, like I always say, hey, listen, like we think this is the best option to do this thing you're trying to do, But if you're trying to capture value of a distributed network, it's really hard. And I think what the fundamental thing around capturing value of a distributed network that no one wants to really talk about is the fact that most of the value, generally speaking, can't be captured. So, I think let's talk about Ethereum and ETH. I think that's a really great example of, a pretty valuable network for our world and for the decentralized financial infrastructure, and not really an effective way of capturing value at the base layer. So, I could simultaneously, I'm not really bullish on Ethereum as a network, but one could simultaneously be very bullish on Ethereum and short ETH at its current market cap. And that's not something that really exists in an analogous way in like equities. In terms of your exact question, like which tokens have the best token economics, one that comes to mind, and this is pretty biased because we've designed it for them, but the Metacert protocol. Metacert protocol.
Okay.
So full disclosure, this network is not operational yet. So this is all, theoretical.
And again, just because I'm just interested, how many here know what Metacert is?
Metacert's awesome.
Metacert?
And I'm not a Telegram
what
fan at
Metacert
all,
is?
so-
It is awesome.
and that's where
It
it's
is
generally used.
super interesting project. Yeah. Explain what Metacert is, because it really is.
Yeah, so I think Metacert's a great example of the type of marketplace that wasn't really possible before blockchain, and that's like the reason I got into this and type of things we look for at our fund. So Metacert has been an existing cybersecurity company for years, and they have the largest database of universal resource identifiers, or URIs, on the internet. And a URI is anything that can identify you uniquely. So this could be a crypto wallet address, this could be a URL. So their database basically shows if something is fraudulent, if it's been verified not to be fraudulent, and everything in between. So the way that they've made money now and in the past is companies pay them to use some of their tools, like a Slack bot or a Telegram bot, to make sure that you're not sending your funds to a fraudulent project, or that you don't click on a phishing link in a Slack post. And then for larger enterprises, they have custom solutions for securing these various networks. They realized early on that they're going to be disrupted at some point by a distributed network, where instead of having to trust the Metacert company and have the Metacert company take in funds and then decide how to pay employees or volunteers, that there'd be a network of people where basically the organic supply and demand of how important it is to secure a given link or secure a Slack, secure an email network, a way to match that supply, that demand with the supply of people that are qualified and can execute on verification. So what we have helped them design is a network where people submit links, people verify links, and then companies pay by pulling from the Metacert API.
Yeah, so we've spoken about store of value, and with this project, definitely the goal was to design a token that appreciated as the use of that token grew. And I think that what we'll find in the long term is that probably a lot of projects are better off not having that be one of their primary goals. It's very hard, and it takes, I think, a very specific set of circumstances to have a project that benefits from inserting a token that needs to appreciate. And so if you're trying to raise money via a token, I think you're in for a lot of hardships that might be worth avoiding by raising through equity.
And you say utility token? Or you mean, are you also saying a security token?
Well, if you're...
And that's fine if you are.
I mean, if you're tokenizing some kind of off-chain asset, or paper asset, then I think that you're sort of living and dying by the underlying asset, which is obviously, I think, appropriate. But in terms of trying to create a utility token as a fundraising mechanism, it's, I think, not something that we'd advise to many projects. I think a lot of people who have enlisted the help of token economists are people who have raised money having previously promised a token and now need help delivering on that token in a way that at least there's a shot of success.
Well, then it's just, so then under what circumstances do you think it's
Yeah, so I think when you're looking at utility, or I like to use the word like network token, because utility tokens become kind of a dirty word in the space. So like well-designed network tokens where without this token, there
But
is
a
this-
network token being a utility token. just to make sure that I understand what you're saying. Because again, what I, and again, I totally appreciate nomenclature is so super important.
So I want to clarify.
Yeah.
So I would say all network tokens are utility tokens, but not all utility tokens are network tokens. So a network token is something that actually adds value to the network for existing, not just being used as a utility within a network.
So, and again, we all have the frameworks that we're trying to put it in, and it's
Yep.
early, and that's, and that's part of the struggle of any new industry, is getting everybody to be using the same words for the same thing. So when I think of a utility token, what I think of that just is a frequent flyer mile, as it's an incentivization mechanism that you're rewarding people because and you're trying to get them to behave in a certain way. You're trying to get them to fly you more, and therefore you're giving them this reward. And that's what I think utility tokens are.
What?
I would say that a frequent flyer mile is a great example of something that's a utility token, but not a network token. So let me get back to your original question, which is, what are the types of network in which it would make sense to have, let's say, a utility or network token? And I think it's a very specific, as Jack said, specific set of circumstances where it's networks of power users, networks that really benefit from its distributed nature, where it's not just the kind of traditional business model of you have some existing company, you provide a service or a product, and then users pay for that. Those types of like transactions don't really benefit from having their own token. Metacert is an example of power users, where you're going to have people verifying links, you're going to have people submitting links, and for them to do their jobs more effectively and have greater incentive to do so, by being compensated both on their efficacy and on the value they provide to the network, creates a better network. So networks with power users, networks where it's not kind of like business and user, but things that are more murky, those are good examples of when distribution and tokens within a distributed network make sense.
All right, and is it a one token system or are there multiple tokens?
With Metacert, one token.
And what is that token trying to engender in terms of the people? So obviously, like for Bitcoin, what they're obviously trying to engender is hashing power.
So,
Or BTC, that was, yeah.
so in Metacert's case, what's sort of odd about their business is that the people who build that registry are not employees of the company. And in order to create the highest value registry, their theory is that you want to build that registry in a decentralized fashion. Because if the person who's providing this registry is paying everyone and telling them where to go and look for things and proving, yes, this is fraudulent, no, this isn't fraudulent, then there's an avenue for censorship that could reduce the confidence consumers have in that product. So the reason for a token here is that it allows for a sort of algorithmic way of paying the people who are supplying this registry, and having programmable money in this instance is extremely useful because it allows for the creation of certain incentive mechanisms such that you can ensure that people are acting in the best interest of the network and to create the best possible registry by virtue of the sort of smart contracting functions that are associated with the token.
So instead of trying to guess the supply and demand, it captured the supply and demand and the value of the service, whether you're getting paid to verify a link, a certain type of link, submit a link, that then is processed algorithmically as opposed to a company guessing.
And it's important to understand also that this is not a purely decentralized project. There are just the one aspect of this project that required decentralization was the creation of the registry. The registry of URIs had to be created in a decentralized fashion so that it could be trusted. But other business functions are not decentralized. So the composition of that registry in terms of where a resource is allocated is actually influenced just by the preferences of Metacert, but the specific links are all discovered in a decentralized fashion. So with decentralization, because there's a cost, typically the areas where that's going to give you a competitive advantage are where you have to manufacture trustless trust without the parties actually being able to organically trust each other. And this is one of those cases But what's also unique about this case with Metacert is that there's a very natural way of limiting liquidity, and there's a natural way of having the token velocity be kept low. And token velocity is another thing that's become a little bit contentious. Basically, what we're talking about when we talk about token velocity is.
And why? Well, explain why it's become contentious for the people who.
So a plug, you should explain it, but if you want to read more, Jack wrote a brilliant piece on this called More on Token Velocity.
Creatively named.
Yeah.
Yeah, there was if you guys are familiar with the BAT project, they had
Basic attention.
Yeah, basic attention token. They are a company that I would say is subject to the velocity problem, and because they know this, I think, they have a paper on their homepage called On the Velocity Problem, which is sort of an effort to discredit what a lot of investors have deemed the velocity problem. So let me take a step back and explain what that is. Essentially, there's
How many people here are aware of the velocity problem? Okay.
So I would, if there's something that the tokenomics field has provided us, it would be this, I would say, is the #1 contribution of token economists thus far.
I'd agree with that.
Yeah.
That's the #1 thing that I've learned.
We'll
That is so contravents to everything you were told before.
Yeah, and, okay, so the velocity problem, there's something called the equation of exchange, which is that MV equals PQ. Alright, so what are all these? M is, for the purpose of a crypto audience, we'll call the market cap of all tokens. V is velocity, which is over a defined time period, the average number of times.
I think part of the problem, and I don't mean to cut you off, Siri, but I'm part of the problem, and you continue in whatever way you want, but I think part of the problem as an industry that we struggle with is, look, nobody knows how this works. I never took a lesson in why does this do what it does. All I know is this adds massive value to my life. And so like, I'm always like, how much do people need to understand? Like MVPQ, for me, I think the salient point is.
I want to understand, please. Can we let him finish?
Rock and roll.
Yeah.
And I want to.
Central bankers would
And
like
by
to
the
know
way,
too.
it's incredibly important. All I would say is the headline, and I'll let him continue because I do think it's incredibly important, and I appreciate you guys being here, obviously, is that the more a token is used, the prevailing economic wisdom is the higher the velocity, the lower the value.
But only in one
Yeah.
case, if this token is value transfer.
All
If
else
not-
being equal. All else being equal, the higher the volume, the lower the value. And that's in contravance to the prevailing wisdom you heard at the beginning of 2017 was I'm gonna get more people to use it, and the more people who use it, the more valuable it's gonna be. And in fact, the more people who use it, the less valuable it's gonna be.
So,
Is what common economic wisdom would tell you, in terms of macro monetary policy.
I'm gonna respectfully disagree.
And that's fine, okay.
I think that.
And I appreciate the respect.
We should define which side of the equation we're talking about. With the
Yeah.
Exactly.
MV equals
Yeah.
PQ.
Can we please finish? Yeah.
So defining our variables again, and I'll try and do this as quick as possible. So like we said, M is the market cap of all tokens. V is the average, over a given time period, the average number of times the token was spent. P is the price level of the things that token is buying. And Q is the quantity of the things that token is buying. So it's really just an accounting tautology. It's saying that the money spent equals the things bought. Okay, so essentially what people have pointed out is that just because you have to buy some sort of product with a specified token does not necessarily mean that that token will become valuable. So it's confusing to people why that would be such. Let's imagine that I created some sort of platform that sells distributed computing space. And I say that the only way you can buy this space is you first have to buy file token. And then you can use file token to buy this computing space. So So logically, you would think that the more computing space bought, the more valuable this token will become. And it's true that that trend is likely. The problem is that what could happen is even if people are buying more things, if instead of spending a more valuable token the same amount of times, they're spending tokens more often, the market cap doesn't necessarily go up. So essentially, the velocity problem is something that would be better called the nobody wants this token problem. And so if no one
I
wants,
like that, that's awesome.
this is what I was saying in the article, is that the reason it's been discredited by a lot of people as not a real issue is because the way it's presented sounds ridiculous. Like, of course, if people buy more computing power, then this token has become more valuable. And I agree, that is extremely likely. What this is an explanation of is the fact that even if you're doing $1 billion annually in sales on this platform, if no one actually wants to hold the token, then you could just be having a rapid, I buy the token, I buy the computing space, the person who sold me the computing space instantly sells the token to someone who now turns around and buys more computing space. And so if I'm an investor and I bought this token, I want to know that if your platform is doing $1 billion in sales annually, that I'm going to see some of that. And if the only purpose of the token is to buy the thing that is being sold, there is a mechanism, which is token velocity, for that token not becoming valuable. And so what a lot of people have tried to do are create things on their platform to lower the velocity and basically create an economic incentive to hold that token. Now, Metacert is a good example of a company where this works well, because the main holder of the token is basically a bank controlled by an algorithm. And so as people are buying in and paying for this protocol, they're buying token and basically giving it to an algorithm that just holds it until it needs to spend it. And so it's not a competitive disadvantage in this case to force people to hold money. Now, in a lot of other crypto businesses, the effort to create incentive to hold the token so that it maintains economic value, I think is going to be a competitive disadvantage. Where someone else could offer the same product without making you just hold this token. And so how do you actually insert a token into a business is very much an open question. And I think the reason utility token has become a dirty word is because the impetus for this was maybe in some cases to build a better product, but in most cases I would say it's regulatory arbitrage. And it was a mistaken regulatory arbitrage, I would say, as we're seeing now with Kik, which is being pursued by the SEC for selling unregistered securities. So I think the reason that utility tokens are thought of as dirty is not so much that people don't want tokens on the platforms, it's just that it's proven to be a poor way to get around securities law.
So,
I have a question.
I'm sorry, just hold on. So, we believe that the major value of CryptoMondays is networking, so we will do plenty of time. So we'll take a couple questions. Sorry.
Yeah, so I'm not sure exactly understood, but like the existence of the bank, you said is an incentive for people to keep the token?
It's not an incentive for other people to keep.
I'm sorry, what's the question again?
It's like, is the existence of the bank an
Of a what?
incentive?
The algorithmic bank for the Metacert protocol.
Yeah, is it an incentive for people to keep the token?
No, but the bank is essentially a person.
Is doing the job of keeping the tokens?
Yeah, the bank is accumulating
To reduce the
tokens.
velocity.
And so actually there's a dividend mechanism through burning tokens. And so the bank is essentially accumulating token if the product is generating economic value. Because if it's generating economic value, then the amount of money coming in from people who are purchasing the registry of URIs is going to exceed the economic value of what the algorithm has to pay for the generation and maintenance of the registry.
That answer your question? You don't look impressed.
Sorry if this is confusing.
Did that not answer your question?
Yeah, I'm just thinking.
I'm sorry?
Yeah, I'm just thinking.
Just thinking, okay. Jay?
Okay, hey, okay.
So, first off, as a comment. Comment is that scenario that you described where there's very high velocity and a low value token. It sounds like you're describing a thriving network that's actually working.
Yeah.
And maybe that looking at it from the perspective of what's going to get investors the most money is not the way to look at it. But that's, I mean, velocity is an indicator of a healthy economy.
Oh, I agree.
So it seems like that's the wrong thing to do to try to limit velocity in an economy.
Well, I'm an investor.
Yeah, but that's not why we're building the network. We're building an investor. We're building it so that we can share computing cycles.
Well, the problem is, how do you raise money to build this thing that's so awesome? And if you can do it without investors, or you can, pay for your own development costs, then of course, giving something that is just really awesome and is vibrant, but doesn't necessarily reward, like, you can't buy the token and make money doing that. We absolutely encourage that, which is why we think that a lot of token use is not going to be tokens that were initially sold to investors, because that pressure to appreciate is a huge drawback. But for us, we're still investors, and so if we want to buy someone's token, we want it to appreciate in value.
Or, to Jack's point, like, there might be other ways that are more traditional of capturing value on top of that network.
Yeah,
So,
sure.
so the most of the companies that we're looking at in terms of actual companies and where we think that value will accrue, we're kind of generally speaking big fans of the thin protocol theory, that like really valuable networks, the way value will be captured is by like the best companies with the best UI and UX building on top of those networks. And I think the important point that you're talking about, and I think we were talking about a little bit before the talk, which is like, the really great thing about distributed networks is that it's less possible for value to be captured by investors. More value, generally speaking, for distributed networks goes in the form of increased utility to its users, and that's great. But sooner or later, a lot of the crypto retail investors that end up investing in these things will realize, hey, I thought I was actually investing. I didn't think I was supporting someone's project to do this distributed computing thing. And then after that, it's going to be harder to fund the distributed networks that actually we want to fund and see in this world.
So is it Joe? James.
James Deli James.
Okay, good question, good point. So there are a few problems. The first problem is when you look at ICOs and the regulatory landscape, that muddies the water in terms of the mechanics of tokens and how a utility versus security could work in an ideal context. Because you've got a lot of people who are basically trying to raise money and they're trying to force fit it into a compliance scenario, which doesn't necessarily make for the best token design in the first place.
Sure.
That's an issue. But I think the thing that I find missing in the conversation around tokenomics is the economy itself. So to Jay's point, if you've got a vibrant, high-velocity token, then you have a vibrant economy. And the issue is really around who benefits from a vibrant economy, and what are the assets? What is it that can be owned in the economy? Now, yes, you can have the enterprises, the applications that build on top. That's essentially the Google, Facebook model versus the internet, which is the open protocol, the system, all the value accrues to them, and that's fine, and that's key because we need that innovation. But the real issue is the underlying economy, who benefits from it. So look at the US dollar, for example, very high velocity currency. Supposedly US citizens benefit from this vibrant economy. And we know that enterprises play a key role in generating this productivity within the economy. But what is the instrument through which we own or have access or benefit from the economy? And it seems this is a missing piece in the whole sort of token discussion.
Well, I think it's missing because for most of these networks, it's just not a good way to capture at that layer that you're talking about. And that's fine, but we just need to be honest about that. And then, hopefully our crypto capital markets will start allocating more efficiently to ones where it is possible.
Right. Because in your model around the computer power, it's the guys who have the computer power, if there's more demand for computer power, assuming price, demand rises and supply is constrained, then the value of providing computing to the network is how you actually benefit from this economy. Right?
Users, not owners.
Exactly.
The users are the
Yes.
yeah.
So in that example, the person who was squeezed out, if this person theoretically exists, would be the person who invested in that token, expecting to see a profit. I definitely think that the idea of we need to limit velocity has been taken too far. I think that when you look at some of the decisions that have been made around Bitcoin BTC, a lot of it is around this idea that we want people to hold. We don't want them to spend. With this sort of idea that people spending your currency increases the velocity, which lowers the value. The thing that they're not seeing is that if you're spending money on things, then that's good. In terms of like, the store of value, I think the tension comes because where these things become value is when people want to hold them. So I value holding this token more than I value holding like the equivalent number of dollars based on a current exchange rate.
But why is that different than a frequent flyer?
So I could speak to this. I'm also involved in the frequent flyer miles business, and have a business that makes money as being a middleman, arbitraging miles and points. And the way frequent flyer programs make airlines money, and in 2018, it was the largest, and for two of the airlines, only profit center of United, American, and Delta. Basically by the delta between the perceived value of these miles or of these points and the actual balance sheet value. So Delta might sell, their miles to American Express at maybe like 0.6 to 0.7 cents per point. The average user, even if I'm not thinking about it this way, in their mental model will, look at it as like 1.3 cents per point, and then it'll only cost the airline an average 0.35 cents per point. And that delta between both the 0.35 and the 0.6 and the 0.35 and the 1.3 is how the airlines make money.
And the credit card companies.
Yes, well, the 0.6 and 1.3 for the banks, the credit card, for the banks, the users of the credit card. So every loyalty program, and frequent flyer miles and points are like the biggest kind of loyalty program and embodiment of this, are kind of like in a way like tricking you, where like.
And how analogous do you see that to crypto and projects and?
So the goal.
And again, you use the word trick.
Yeah. So
But obviously, trick has a pejorative element to it. Which I assume you meant. And in my view, like taking advantage of arbitrage is what communities are all about, right? The amazing thing about communities is when communities work, right? Everybody gets more out of a community than they put in. And that's what makes communities so incredibly powerful. And the most powerful communities are religions because they're able to give faith, which costs zero to produce, but people value incredibly highly, right? And every community plays on that arbitrage. And the airline community, I think, benefits from that same arbitrage that religion does, in that people value what they're getting differently from what it costs to manufacture.
That's definitely one view on it. I definitely see the frequent flyer model is different than religion in the sense that I'm not necessarily sure that if there was price discovery on these loyalty programs, everyone would benefit greater. So you have some people like myself that personally and for my business, I get a lot more than I put into it, Like I know what these miles and points are worth, I buy them for, a lot less than that, and then I, in a sense, use them on myself or sell them to my clients for a lot more than that. So it benefits me personally, but what about all the people that do terrible mileage redemptions? What about all the people that let their miles expire? Wouldn't they, even if they don't think it, wouldn't it be better for them economically to have US dollars or whatever, however they transact in their daily life? So I use the word kind of trick on purpose because the airlines are, I think, artificially inflating the values of these assets so that they can sell them for higher than they're worth. And in a way, if everyone believes that they're more valuable, then they're more valuable. But if there's a little bit of price discovery, even if it's not in like a public market like with miles or points, then there is going to be that arbitrage you know, that isn't a positive sum game. Arbitrage is almost always a zero sum game. So I think having price discovery.
No,
yeah.
no, I totally disagree with that, really. I mean, I think right to religion is there's massive arbitrage between the zero cost of producing faith
Yeah.
and the massive value that people place on faith.
I don't think it's
But-
a zero
but-
cost
but-
in producing faith. I think there's a lot of costs.
But relative to the value, I think relative to the value is the greatest arbitrage in community that I'm personally aware of. But I think what you're talking about is another, I think frequent flyers is another weirdly massive arbitrage opportunity. But it's not, that doesn't mean that it's negative. Everybody wins, right? People are buying stuff that they're valuing at more than they're paying for it. And the airlines is getting more than they value it.
They're not.
And the credit card company's getting more than they value it at.
So the first statement is not correct. They're not getting more than what they paid for it. They're getting less. That's how this arbitrage works. The airlines are giving them X. The users are perceiving it as 2X.
But hold on a minute.
Yeah.
But so is faith valuable? So faith costs zero to create, right? You would agree with that?
No, I wouldn't. I don't think faith costs zero to create.
Okay, it costs, okay, what does the church pay? Let's say it costs $1 billion and it makes 100 billion, so it gets 100x off its investment in faith. Whatever it is, it's a massive multiple. It's the biggest multiple in the history, I think, of community. I can't think of a community, and I don't mean in any negative way, right? Faith is awesome. People, whole lives are made incredibly better by faith.
I think there's a lot of externalities that both with airlines and religions, when they're factored in, I'm not sure I would necessarily agree that there's a positive sum to that. But, you know, I think that's a longer conversation about what the externalities of religion are.
But do you think the people who ultimately buy are happy that they buy, or do you think they're unhappy?
With miles and points?
Yes. I assume they're happy because they're buying it. I'm happy with everything I buy.
So most people aren't buying miles and points. They're receiving it as part of bundled into this other transaction, so they're kind of held hostage or tricked into valuing that more than it's worth.
But everything's a trick, right? I mean,
Yeah,
if
it's all
you're
the-
calling that a trick, then everything's a trick. And capitalism is one big trick, which
I
is fine.
wouldn't
Yeah.
say that. I'm saying very specifically that when something is worth X and there's not price discovery on that asset, whatever it is, and everyone is kind of saying and agreeing and showing that it's worth 2X, but the airlines are then really kind of buying and selling it for X, then that's kind of a trick and that's not capitalism.
Okay,
Yeah.
so I'll let, hold on a minute. One more question from somebody who hasn't asked a question yet. Have you asked a question yet?
I have not asked
Okay.
a question.
All right.
So this is gonna go, and it's kind of related to James's question and Deli's question, but I'm gonna try and make it, presumably this could be a slow pitch down the middle for you. So why have a token? It's Metacert? Is that what the name of the company is?
Yeah.
If I heard correctly. So why even have a token? Why not simply say, we'll give you BTC or we'll give you USD, and every time you provide a URI, we'll give you X, and every time you verify it, we'll give you 1.5x, presuming that verification is worth more than simply shoving it at you. So why not that? Why do you need the token inserted in there?
I don't think you necessarily need the token, or could you do this with, smart contract with some sort of other asset? I think probably. So I don't want to speak too much for them in terms of their specific reasoning behind that decision, but I personally am not bullish overall on, what would be the total value of non-protocol tokens in 10 years. I think my number for that I put some serious thought into it is probably lower than a lot of other people in crypto, because I think that what you're pointing out, that you could substitute in some sort of other asset in a lot of cases, is very much true.
I think with Metacert specifically, if we have a smart contract platform and some type of stablecoin or USDC or some synthetic thing that was at scale, would that make the value of the Meta token less valuable compared to that solution? Yes, I think we're really far from both of those things, so a token's a much better solution than that. But it's a matter of, when you're submitting or verifying a link, being part of this community. And there's a lot of other kind of distributed networks with staking as well that are now, that work like this. If you're forced to basically kind of be part of this community and have exposure and having skin in the game, you're probably going to be more invested, and as a result, you're going to make the community more valuable than it otherwise would be. So in an example like that, where you're actually working, and it's not just like, you know, like the airline example where it's like, I have this airline, I'm a user, I'm captive to getting this. This is people that are like choosing to do so. So I think kind of back to what I was saying before, when you have networks of power users and less like kind of company and user, that's an example of where token could make sense.
I appreciate your argument. I would argue that actually in this case, you first of all, you've definitely handled Lou's faith-based argument here, but I would say that in a very real sense, I think you're saying that if people believe in MetaCert and want to be a part of this, this is almost a faith-based argument actually for why you want to be involved in the MetaCert token.
Having economic exposure to the network, it's not faith, like.
Well, I'm saying in the sense,
Yeah.
in the sense that they could have had, right, a BTC or USD exposure.
But now that's a barrier to entry to that exposure.
Yes.
Yeah, but there has to be-
This is the difference.
Okay,
There has
so-
to be some sort of discount, some sort of reason why people are motivated.
I think it's
to
very
token.
interesting, by the way.
In in MetaCert's case, I think part of the reason a token is more viable is because of who actually is forced to use it. It's not their customer, and it's not a supplier who has some sort of, you know, large bargaining power. People who are, the individuals who are forced to deal with MetaToken are people who are providing verification services to the network. And this is a distributed group of individuals who are, I would say, unlikely to unionize and demand to be paid directly in like Bitcoin and or some sort of fiat. So I think in their model, it's lower friction to insert a token. I think in a lot of other models, two competing products where one forced their consumers to buy a token first and the other didn't, the one who didn't would be at a large competitive advantage. In this case, I don't think that's so. But like I said, we think they're unique in that a token is not, you know, a huge red flag sell-off point for them, you know.
Yeah.
So look, these guys were awesome to come here and talk.
Yes.
This is early. Let's give it.